we
No.
switch into this? Okay, let's shift gears. So that's the cream in the coffee pro rata rule. Can we talk about capital gains? And so this came across recently. I had somebody ask me a question about capital gains, and what their question was around was the brackets and how do I determine which bracket I'm in? What income or what amount of money do I use to determine the bracket, right? Because their assumption was, which was incorrect, but I understand their logic was that okay, if let's say I sell assets from a brokerage account and I have $20,000 of gain, right? So I paid capital gains, long term capital gains. They assume that I'm just using that $20,000 to determine where I land in the brackets. However, there's this income stacking, right? And so,
Yes.
so do you want to touch on income stacking, how you kind of fall in the brackets there?
Yeah, this is something that really needs a visual to make clear to people. And I've been saying for
Right.
2 or 3 years, I'm going to make a video about this. And I just never got around to it to show the visual. But let me try my best at trying to verbally explain the visual. So yes, there's regular ordinary income tax brackets where each bracket starts and stops at a certain level of taxable income.
Mhm.
Now, I say taxable income because you start with your gross income, whatever that is, minus out your standard deduction or itemized deductions, and there might be some other deductions, but whatever, let's just assume standard. And that smaller net amount, that's the amount that gets run through the brackets as we know them, the taxable income. Now, there's separate brackets that apply just to long-term capital gains, meaning things you've owned for more than a year before you sold them in a regular brokerage account.
Mhm.
Or qualified dividends. I won't get into what those mean, but largely dividends on US stocks are generally going to be qualified. So they're taxed at these lower rates. And so there's three long-term capital gain and qualified dividend tax rates federally: 0, 15, and 20%. State, whole different ball game. As we talked about, like states usually tax these as ordinary income. I'm not aware of any states that have like special reduced capital gains taxes, but there could be some.
Hawaii actually does. So Hawaii has a flat
Oh,
seven
interesting.
seven and a quarter
Okay.
percent capital gains tax rate. Yeah.
And that's lower than ordinary income, or at least on some ordinary income, it's
Yeah,
lower.
yes, I would think, well,
Okay.
actually, I would actually think it's kind of middle of the road, actually, but
All right.
yeah,
So maybe higher, maybe lower, but
yeah.
okay. So good to know. I thought most, if not all states just apply their normal tax rates, but so there's these three brackets that apply just to long-term capital gains and qualified dividends. Now, how do ordinary income and these long-term capital gains interact with one another for purposes of these long-term capital gain brackets? Well, there's stacking, like you said. And the long-term capital gain brackets are based on taxable income as well, so net of standard itemized deductions. So let's just assume, I'm making these aren't the actual numbers, but I'm going to try to make it up to keep this super simple.
Yeah.
Let's assume the 0% long-term capital gains bracket stops at $50,000. So that's $50,000 of taxable income, meaning, again, gross income net of your standard deduction, let's say. But any ordinary income you have will first crowd out some or all of that 50. So this is going to be complicated, but let's assume standard deduction's 20. It's not, but it's super
Yeah.
basic math. And you have $100,000 of pension. So that's ordinary income. So your gross income's 100. Your taxable income is going to be 80 because it's 100 minus your standard deduction. So right there, you already got 80 grand of taxable income.
Right.
If your long-term capital gain 0 bracket is 50 grand of capital income, you've already blown past that because your ordinary income fully crowded it out.
Right.
So any long-term capital gains you do have now will sit on top of the 80 grand of ordinary taxable income you already have, thus putting your capital gains into the next capital gain bracket of 15%. Alternatively, again, I can feel people just like spinning their heads because there's too many numbers here. But
Yeah.
let's assume your pension's 30 grand.
Right.
All right, so 30 grand, standard deduction's 20. So now you only have 10 grand of ordinary taxable income. And if your long-term capital gain bracket is 50,000, you've only used up or crowded out 10,000 of that with your ordinary income. So that means you can realize up to 40 grand of long-term capital gains that would all be taxed at 0 federally because it fits within this bracket. any long-term capital gains above and beyond 40 grand would fall into the next capital gains bracket of 15. It's not all or none. Like you can have amounts in different brackets.
Right.
So that's at a super high level. That's how those brackets and the stacking concepts work.
No, that's great. And it is, I haven't come across a really good, like you said, a visualization that kind of outlines it. But no, I think hammering home the point of those brackets are based off of not just your capital gains income, but your taxable income, and then add your capital gains on top. And the capital gains brackets work the same as income tax brackets in that they're progressive. You pay some in this bracket, and then it goes over from there.
Yeah. When I ever get around to doing this video, I'll be sure to let you know because it's going to be amazing.
I don't doubt.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.